Oh, I think we're live. Are we live? I don't know.
Yeah, you
It
are.
says we are. Okay. Third time lucky. So, today we're talking about waterfalling bank accounts and how to make sure everybody gets paid. And this is a special request for Carl, who asked us, how many bank accounts do I need in order to make sure people are paid? So, Harry has a lovely prop that we created earlier, and we have switched our screens around, so you should be able to read this. So, for the purpose of this video, and in order to have an example to work from, we're going to assume a typical sale is £100 worth of goods, products, stuff, plus £20 VAT. So, £20 VAT, we've got a cost of sales here of £30. We're going to have overheads in this example of £20 and then a net profit of £50, of which £10 is owed to HMRC for either corporation tax if you are a company or personal tax if you are a sole trader or a partnership. So, how do we manage these accounts? How do we waterfall them? How do we deal with this to make sure that of the cash that comes in order to pay our debtors are paying their bills off, what do we do with the cash to make sure that we've got enough money to set aside to look after our taxes, make sure they're all paid on time? So I'm going to take this prop, I'm going to move it over like this, and Harry is going to talk you through the first stages. So how many bank accounts do we need, Harry?
So firstly, you'll naturally have a bank account for yourself, but we'll also need several business bank accounts. We'll need one to cover our general overheads and, of course, our cost of sales. This is also where all of our sales income will come into. And we'll also want one for VAT and one for corporation tax. Now, if you do have PAYE liabilities as well, you can also have one for this. It really just depends on how many taxes you have. Now, first things first, when you make a £100 sale, if you're VAT registered, you're going to be required to charge £20 worth of VAT on top of your sale. Now, the first thing we should do when we receive this money is set aside the £20 of VAT. Now, if you receive more money than this, just take 1/6 of the total amount you receive. This will account for the VAT element only. Now, we set aside this each month, well, every time we receive funds, but we only pay VAT quarterly. And what we would say to do is set aside all of this money, and essentially when it comes to the end of your VAT recorder, if you've made any purchases which are subject to VAT, you'll be entitled to recover VAT against these sales. But we're still saving the full £20 per sales value. This is because any recoveries we make will simply be a saving which we can reallocate over to our corporation tax account. So essentially we've saved for VAT and we've also saved for corporation tax in the process. So this is how we waterfall. We build up in the VAT and anything left over goes down to our corporation tax account.
Now, if you run a quarterly VAT return, then you probably are able to calculate a more precise percentage of the income that you need to put aside to pay your VAT. Now, we do see companies do this, and we see them putting aside just enough to cover their VAT, but at the end of the year, it then becomes difficult to try and manage their corporation tax or their personal tax. So it's a really, really good discipline, if you can, to put aside that £20 every month or every time somebody pays you from your current account down into your VAT account. You run your VAT return, you post your VAT return, pay off your VAT, anything left over gets waterfalled down into your end of year profit account, whether that be corporation tax or personal tax. Now, if you have an accurate set of management accounts run each month, you should have an accurate forecast of how much corporation tax, or reasonably accurate forecast of how much corporation tax on the profits that you've made will then be owed to HMRC. So you can use that estimate every month to check that you've got enough put aside. Now, that does mean that you have to have relatively accurate and up-to-date management accounts. A month or two out of date is fine. 6 months to 9 months to a year out of date, no good at all. You're just guessing then whether you've got enough put aside for your corporation tax. So again, we bang on quite a lot about knowing your numbers and understanding how much you should be earning and how much tax you can pay, how much you can take out of your business. You won't know any of that unless you have accurate management accounts each month. So going back to our model, we know going back to our model, we know that in our cost of sales, we've probably got payroll as well. Now, if you're running a director's payroll, the tax and national insurance is going to be relatively small, so it probably doesn't need saving. You will just pay it as it's incurred. If you have a team of people, a team of staff, that are either going to be directly working on the product or the service that you're selling, their sales will be in cost of sales. If you have admin staff and a team of people looking after your sort of back office systems, these people's wages will be sitting in overheads. Now, if you run payroll weekly or monthly, you'll have between 3 to 4 weeks, maybe 2 to 3 to 4 weeks, but at the end of the month, where you know what your payroll liabilities are going to be, and you know that they're due on the 19th of the following month. So you've got a few weeks to put aside enough cash to pay your PAYE. Now, some clients like to have a separate PAYE account, but because it turns over so quickly, it's almost as if they're another supplier. So long as you can estimate or calculate accurately your PAYE due, try to put aside perhaps a quarter of that each week, so that you know you've got cash put aside. If you're cash rich enough and you don't have to worry about it, that's fair enough. VAT and corporation tax is probably slightly different. These are the areas that we do see people struggle with, and we see people have difficulty in trying to pay. So again, it goes back to prioritising your taxes. Definitely put aside PAYE, definitely put aside corporation tax, and then what's left over goes to pay your overheads, your cost of sales, and you.
Now, it's really important that we prioritise that first, because out of all of the taxes, it is the most horrific for interest charges and penalties, and it is the most crippling by far out of all of them. PAYE, not so bad on interest charges. Obviously, we don't want to miss it because it's money that essentially you won't get back. But VAT first as a priority, which is why we say straight away, as you receive the money, set it all aside. After all of your taxes have been dealt with and your suppliers have been handled, essentially any profit you make and any remaining funds can of course be taken as dividends and of course drawings. So it's really important that we make sure we get these out of the way, and then you can go, okay, yeah, this is available for me. And to be honest, if we're not making money and we're not able to draw funds out, it sort of questions why you would personally be in business. What do you have to gain out of it? So it's important you obviously think of yourself, but prioritise VAT as well. You don't want to miss out on that.
Yeah, it's definitely the most important one. Now, the thing that we have missed off, that we deliberately didn't include in our overheads at the moment, was CIS reporting. And if you've got CIS tax that you need to pay, in a similar way to your VAT, I would suggest putting aside that CIS tax. It's cash that you know you owe once your suppliers or your suppliers have paid you. Put it to one side, once your customers have paid you even, put it to one side and make sure that that cash is put aside for HMRC. HMRC is probably the most important creditor there is. They're the one creditor that can close your business down if you don't pay them on time and in full. The penalties are horrendous, and it's just, the further you get down the route of being in debt with HMRC, the more difficult it is to get out of. Having said that, the most fundamentally important reason for being in business is because you, the sole trader, the businessman, the entrepreneur, the director, wants to earn a living, needs to earn a living, and has personal bills to pay, has a life to live, families to support, and all that kind of stuff. So the next stage of this conversation that we were looking at is, can your business afford you? And that we're going to look at tomorrow. So thank you very much for joining us. If you enjoyed it, please like and share. We'll run another one tomorrow morning on, can your business afford you? Bye for now.
See you then.